You spot what looks like a perfect setup, a clean downward trend line, a strong rejection candle. You enter the trade feeling confident, and then the market immediately reverses and spikes straight through your stop loss. If you are only looking at a single time frame, you are trading completely blind to the larger market structure. To stop falling for fake breakouts and market manipulation, you need a structured multiple time frame analysis system. Think of it as a technical filter for your charts. Mastering a strict 3 timeframe system takes you out of the business of gambling on low timeframe noise and allows you to execute trades aligned with the momentum of the higher order trend. Step 1 is defining your boundaries. You must select exactly 3 timeframes tailored to your trading style, a higher, medium, and lower timeframe. This matrix shows how to structure them. Swing traders need a wide view, the 4-hour, 1-hour, and 15-minute. Intraday traders move faster, using the 1-hour, 15-minute, and 5-minute, our working example today. Scalpers need the tightest view, 15-minute, 5-minute, and 1-minute. Locking in your specific trio before you even open a chart prevents impulsive timeframe hopping and establishes a strict rule set for every trade. Step 2 is establishing your anchor. You start your analysis entirely on your highest timeframe, in our case the 1-hour chart, to find the overarching market direction. Looking at this 1-hour chart, we identify a clear bullish structure by tracking consecutive higher highs and higher lows. Connecting these peaks and valleys reveals the true upward momentum. This brings us to the golden rule of the anchor timeframe. The structure here dictates the only acceptable direction for your trades. Because this 1-hour chart is bullish, shorting is strictly forbidden. Adhering to your anchor ensures every entry is supported by the larger trend, filtering out low probability setups that attempt to move against the prevailing current. Step 3 is mapping the battlefield. We shift down to the medium timeframe, the 15-minute chart, to locate where retail traders are incorrectly positioning themselves. This 15-minute chart shows a classic double bottom pattern. Many traders buy here, placing their stop losses in the area right below the pattern. We call this cluster of stop losses internal liquidity. These shaded liquidity pools are not places to enter a trade. Instead, they act as magnetic pull zones for price action, making them the exact profit targets we will aim for later. Your medium time frame acts as a tactical map. It clearly highlights the traps you need to avoid and the exact targets you need to hit. Step 4 addresses a major point of confusion, the moment when your higher time frame and medium time frame show completely opposite trends. Look at this split screen. The 1-hour anchor is bullish, but the 15-minute displays a downtrend, direct conflict. This opposing move is just manipulation, designed to trick sellers. You must wait for the 15-minute structure to break its lower high, shifting back into bullish alignment. Recognizing this manipulation instead of reacting with FOMO allows you to remain patient until the lower timeframe structure actually aligns with the primary trend. Step 5 is execution. Now that timeframes are aligned, we drop down to our lowest timeframe, the 5-minute chart, to place the actual trade. Here is our 5-minute entry trigger, a downward wick sweeping liquidity, followed immediately by a strong bullish rejection candle. We buy here. The stop loss is placed below the wick, and the take profit extends up to our previously mapped internal liquidity zone. Executing your trade on the lowest time frame ensures maximum precision, giving you a high probability entry with tightly controlled risk and a clear reward. The setup plays out according to the higher time frame. Price advances rapidly, filling out the reward zone until the target is reached. This clean execution was only possible because we aligned the trade with the momentum of the higher time frame, ignoring the noise on the lower charts. Now it is time to practice. Open your charting software, select an intraday trio, and backtest this exact framework 5 times before risking any real capital. If you want to master technical analysis and smart money concepts with a structured step-by-step approach, check out our 30-day trading course linked in the description. Consistent profitability in the markets is built on strict rules, extreme patience, and the ability to view the market from multiple perspectives.